Today's stock pick of the week is Phillips 66, symbol PSX. Phillips 66 is a oil and related chemical company. It's a diversified energy manufacturer and logistics company with a portfolio of midstream, chemicals, refining, marketing, and specialty businesses. The company produces transport, stores, and markets fuels and products globally. So basically, it's a large oil company. It was founded in 1875. It has 14,600 full-time employees, and the company is based in Houston, Texas. The company today, the company's market cap is about $39 billion. It has revenues of $111 billion, profits of $5.27 billion. It has a PE ratio of 7.59. The annual dividend yield is 3.2%, and the debt is $11 billion. So as we talk about every week, I have analyzed the companies independent of the stock price. I simply want to know, is this a solid company? And once I've done that, then I try and decide what price would I pay for that company. So the way that I do that is I analyze the company in 29 different categories, 9 of which are operating, 10 of which are financial, and 10 of which are management. Operating is how well they deliver goods and services to their customers. Financial is how much risk they take on in terms of debt and how they manage their debt. And finally, management is how good a job they do in terms of returning money to us, the shareholders. So this company is solid. But I would call it barely in the investment grade. I kind of grade companies on a scale of 1 to 4, just like in school, 4 being an A, 4 being the highest, 1 being an F. And for me, I want to see a company with a grade point average of at least 3.0 in order to be investable. This company is at almost the exact limit of that. It's 3.03%, but it is at 3.3% in terms of management, which I like. It's 3% in terms of finance, which means there's very little risk of bankruptcy or the company going broke. Operating this company has some issues by virtue of the fact that it's an oil company and therefore a commodity company. And I don't normally like commodity companies. But when they're so cheap, when they're very, very cheap, then I think they're an intelligent buy. And this is an example of a commodity company that's simply very, very cheap right now, trading at less than 8 times earnings in a market where the average is closer to 20 times earnings. So the first thing and the biggest thing that I hate about this company, and the reason that I almost didn't buy it, in fact, one of the reasons that I did buy it is because it's been a holding of Warren Buffett's for a long time. He's since reduced his stake, but I disagree with him. I think at this price it's worth buying. But the biggest problem with this company is these gross margins. If you see they're in the bottom 10% of companies in terms of gross margins. But having said that, they're an oil producer. They've been operating this way for a very long time. It's a low margin business, but it's also a business that isn't going away. Despite Tesla's best efforts, we're gonna need gas and oil for a long time. And while there'll be new companies coming online and new oil finds, in the long term, I think a well-run oil company will do fine. And as you will see, in terms of the way they do many of their issues, R&D and other issues, they're in pretty good shape for oil companies. So recognizing that this company gets an F in gross margins and recognizing the gross margins are the single most important thing that I look at in a company, the PE ratio is simply enough that I'll look at the whole story, not just this one category. Earnings and earnings per share, they're basically the same, a little bit higher increases due to the fact that they have been buying back shares pretty consistently, as you'll see. But you can see that the oil company, you have to understand the oil business has been in a very rough patch. For the last 5 years, oil has not been a great business to be in. But even through all that, you'll see that this company has remained profitable, and for the last 2 years has been profitable, and really with the exception of 2016, has sort of been in a pretty solid upward trajectory. So when you couple that with the low PE, the dividends that you're going to see, the buying back of stock that you're going to see, the low debt you're going to see, I think this company is going to continue to produce value for us as shareholders, and so I'm willing to buy it. Earnings as a percentage of revenue, again, is low. It's in it's in sort of the mid-range of companies that I look at. But again, that's simply a function of the fact that it has very, very, very poor gross margins, and that's going to obviously affect its net earnings per revenue. So we talk about my 4 taxes that I look at with every company: selling and general administrative costs, plants and equipment, research and development, and inventory. Those are 4 costs that most companies have to carry to some degree, and the way a company handles those costs is an indication of how good a job they're doing in terms of managing the business. So again, if we look here at selling and general administrative, they're in the top 10% of companies. That's despite having very low gross margins. That tells me that the gross margins, what we're going to see in the next few slides, tells me the gross margins is a result of the products that the company sells, not a result of the company being poorly managed. Their selling and general administrative is in the top 10%, very, very low. Their plants and equipment is in the top 10%, very, very low. Those are both really, really good signs. When you move over to inventory, it's not in the top 10%, but it's close enough to the top 10% to be interesting, and that I'm not going to penalize it because it's in the mid-range. R&D, it effectively has 0 for R&D, so it's in great shape for R&D. So for the 4 taxes, this company does an excellent job, which again is one of the reasons why I'm willing to overlook the relatively low gross margins. So debt analysis for the company, especially relative to earnings, has been attractive. It's got $7.5 billion in debt. That seems like a lot, but relative to earnings, relative to the interest costs, this really isn't a big number for a company of this size. I don't like that it's been going up for the last 5 years, but I recognize that the company has been paying significant dividends and buying back stock, and so we're simply trading a little bit of debt for a little bit more dividend return to the owners, and I'm okay with that. If this number was higher and creating enough income to be a problem, I'd be worried about it, but based on these numbers, I'm really not. So one of the contexts that I use when I look at the long-term debt is, how does that long-term debt relate to earnings? I don't really want to have a debt load that's so high it'll take us 20 years to pay off the debt. I like to have it so that about 3.5 or 4 years of income could pay off all the debt. And you can see this company is below that number, has been below that number year after year. So in that context, the debt doesn't seem very high, even though it's $7.5 billion, because the company could pay off the debt in less than 3 years income if they wanted to. So this company is, debt speaking, in pretty good shape. Interest expense and operating income, you can see the interest expense has gone up every year, but I have a goal that a company not spend more than about 15% of its income on, 15% of its operating income on interest expense, and with the exception of a couple of years, this company is consistently below that number. So again, no cause for concern with the level of debt this company is carrying. It's not going to get a 4.0, but it's in the solid B category. Another thing I look at is interest coverage ratio. Interest coverage ratio is the multiple of the number of times of the income, the number of times that the income is greater than the interest expense. So you can see this company is averaging today about 10 times the income that it needs to cover its interest. That's a huge margin, a huge cushion of safety. I'm happy if the company has a couple of times. So we're in good shape with interest coverage ratio, which again leads me to believe this debt's not really a problem. Cash and marketable securities, this number looks like it's been going the wrong way since 2012. When it was about $5 billion, today it's about 1.3 billion, call it. And that obviously you'd say, well, where's all the money going? Well, in this case, I know, and we'll talk about later, that the money's going to buy back shares and the money is going back out in dividends. And effectively what they're saying is, we don't really need $5 billion in cash to run our company well and to have a nice cushion of safety. And so we're going to return that money to the shareholders. And obviously as a shareholder, I have no problem with that. That increases our return on equity and it reduces our return on assets because we have less assets tied up. Those are both good things for me, the shareholder. Current assets to liabilities, again, they have, current assets is money that they currently have in their pocket or that they will get paid within, they expect to get paid within a year. Current liabilities is monies that they expect to owe in the next year, lease obligations and mortgage payments, those kinds of things. I like to see current assets greater than current liabilities. Obviously in this case they are, and they always have been, so this shows me the company is well run and well financed. Also, if you look at the gap there, it's pretty consistent between the two. This is a company that's really decided how much cash they need, and they've got that much cash on hand. That's an indication of a well-run company. Shares repurchased and shares outstanding. This is an important category to me. I don't like to see companies that are issuing more shares. It means they need more money to run their operations, and they're diluting my investment. The opposite of that is that they are buying back shares, which means they have more money than they need, and they're increasing the value of my investment. I'm getting a larger share of the profits. So you can see here the shares have gone from about 650 million shares down to about 400 million shares. That's a nice increase in my equity if I'd owned it over that period of time. And you can see the shares repurchased every year seem to be relatively constant. A couple of bumps there, and they had a couple of bad years, but I'm really comfortable with the amount of shares they're rebuying every year. Looking at the share repurchase through a different light, if you had owned 10% of Phillips 66 stock at the end of 2009, you'd have owned about 64 million shares of stock. If you didn't sell any of those shares, then through stock repurchases, what would have been 10% stake in the company would have grown to 13.85%. So you'd have been at 30%. You'd own almost 40% more of the company than you would have owned originally. Also, the company's earnings your share of the company's earnings would have gone from 47 million to 755 million in that period of time. So you can see there's a couple of really good reasons to like this company and a couple of good reasons to like the stock. They're buying back shares, they're increasing earnings. That's a wonderful pattern to have as an owner of a company. So here you can see the dividend growth in the company. It's gone fantastic, right? Over the last 5 years, the dividends have gone up about 13% a year, and the number has become, it's really, really solid. If this was to continue, you'd obviously probably never want to sell this company. It'd be fantastic. But the dividends and the stock repurchases are two of the big reasons to own this company, especially looking at the low price. But simply saying the company's paying good dividends doesn't tell the whole story, right? We like to know that those dividends not only are being paid now, but we have a reason to believe they can consistently be paid in the future. So we look at dividends in terms of 4 factors: yield and growth, the dividend safety in the context of earnings, the dividend safety in the context of cash flow, the dividend safety in the context of its current debt load. So let's go through those one by one. Yield and growth. The yield is 3.2%. That's just over about 150% of the S&P 500, which is 1.92%. So the company is a good dividend payer. Also, as I mentioned, the average dividend growth over the last 5 years is 13%. So anytime we're getting a 13% growth in the money that comes into our pocket annually, that's really easy to budget future expenses, right? So we like that a lot. Dividend safety in the context of earnings. So this company pays out about 25.7% of its earnings. That's not very much, it's not too high. Their average payout over the last 5 years was 22.3% of the earnings. To put that in context, the S&P 500 is around 40%. And remember, we're paying 50% more in dividends, and we're still using less of our money to do it, less of our earnings to do it than the average company. So this is a company which pays dividends that are great, and it seems that those dividends are not in any way disproportionate to the income. So that leads me to believe that the dividends not only are safe, but the company could continue to increase the dividends for the foreseeable future and still not be in an unsafe range, even if earnings remained flat. So dividend safety in the context of cash flow. So for the last 5 years, cash from operating activities, let's just look at the last year, was $7.5 billion. Their capital expenditures were $2.6 billion. That left free cash flow of $4.9 billion. And they paid dividends of $1.4 billion. So about 29% of their cash flow went to pay dividends. That's really, really good. But it's not good in the context of the last 5 years. They had some rough times in the last 5 years where they either had significant capital expenditures or they had some income hiccups. And so this is something that's cause for concern, right? Is the cash flow going to be something that's going to be make the dividends unsustainable? I'm willing to accept that could happen. I'm willing to accept that dividends might go down, occasionally. But the company's got a good payout history. Their payouts are relatively small relative to their earnings, so they can afford to bump in earnings and still pay dividends for a couple of years as they go through some of these kind of bumpy times that are going to happen in this industry. So it's a cause for concern. You have to recognize that it could happen, but I don't think it's a big concern, and I'm still comfortable with the stock. So dividend safety in the context of its current debt load. What we're trying to do here is look at, if interest rates were to increase, our debt service over time would increase, and that would make it harder and harder for us to make dividend payments. And so I try and look at an extreme case. I say, okay, if interest rates were to go up to 20%, what would that do to this company's ability to pay debt? I can't imagine interest rates being higher than 20%. If they were, the economy would be in such catastrophic shape that it's really not worth talking about much else. So if interest rates were to go to 20%, there would be a reduction in cash flow of $1.75 billion. That reduction in cash flow would because that's the amount of interest we would have to pay on our current debt load. That would mean our new interest-adjusted cash flow would be $3.7 billion. We currently pay $1.4 billion in dividends, so that would mean that we have free cash flow minus dividends of $1.7 billion, which is still okay. We'd be paying 82% of our dividend, 82% of our cash flow, free cash flow would be paid out in dividends, which is, you know, respectable, because that means that the company could literally survive and continue to pay its dividend if it had as much as 20% interest rate. So interest and debt load is not an issue in terms of this company's ability to pay its dividends. Shareholders' equity, you know, everybody likes a stock that goes up and to the right. That's what this one does. You can see that the last few years of shareholders' equity have been pretty flat. Again, the company's been buying back shares. That reduces your equity, and your shareholders' equity, and you've been paying a lot of dividends. So if they hadn't been doing those things, they could be piling more and more stockholder equity, but I don't think they'd be using the money effectively, and that's why they haven't done it. Return on assets. So this is important to me, right? I like to know that the company is using the minimum amount of assets they have to run their business and is paying me a fair return for the assets that they've kept tied up. So anything over 10% puts you in the top 10% of companies, and this company has consistently been above the top 10%. It looks like it hasn't been in the top 10% 2 years in the last, you know, since 1999. So a solid company, does a fantastic job return on assets, which is one of the reasons why I love this stock at 8 times earnings. So overall, what do I think about this company, and why would I suggest that you buy it? The first question I would love to be able to tell you is that does the company have a consumer monopoly? This company does not. It's a commodity business. So that's one check mark against it. If it's a commodity business and it doesn't have a consumer monopoly and I'm going to buy it, it has to be really, really cheap. And this company is. Is the company solid financially, especially if it's a commodity business and it's not a consumer monopoly? I want to know this company is on solid financial ground. It is. It's a solid, mature, stable business and a solid, mature, stable industry. The cost to enter and compete in this industry is enormous. So in terms of financial management, I give the company a solid rating of 3.3, which is in the very, very high range. They have debt, but not high related to earnings, not high related to interest coverage ratio, not high in comparison to dividends. So in that aspect, the finances of this company are very stable. Does the company reward its owners? Yes, the company pays an above market yield of 3.2%. That dividend grows at an average rate of 13% for the last 5 years. Since 2009, the company's repurchased over 30% of its outstanding stocks. So again, very, very solid, even though it's a commodity business. This company's earnings have had some bumps over the years, but it's never lost money. And it's in an industry that's been hit very, very hard. However, that's the reason we were able to buy this company at a PE of less than 8. So yes, the earnings don't go up and to the right every year, but they've never lost money, and we understand the industry went through a hard time, and it's so cheap we're willing to buy it. So because the earnings, the P ratio is 8, I believe there's 4 ways we're likely to profit from this stock. I believe that the earnings will continue to rise, and as those earnings rise, it'll cause an appropriate appreciation of our stock. I believe the P ratio is far too low. So I think even if earnings didn't rise, I think that we could see the PE ratio expand, and that obviously would be fantastic for our ownership in the stock. I believe the company will deliver good dividends, and so basically as a bank, just put the money there and earn my dividends and wait for good news to happen. I'm happy to do that, especially because I believe the company's going to continue to buy back stock. So I believe if any one of those 4 things happens, the company continues to build earnings, the PE ratio adjusts closer to market, the company continues to raise its dividends at 13% a year, or the company continues to buy back stock at the rate of 8 or 10% of the stock in the company a year. If any of those 4 things happen, I think this becomes a very solid investment. I think it's likely that 2 or 3 of those things will happen, which lead it to be a great investment. So would I buy this stock at its current level of 84.81? Yes, I would recommend this stock without reservation. So for the last slide, this is the cumulative picks we've made over time and how they've performed. You can see that the last few weeks haven't been very, by the way, I haven't posted in about a month. I've been preparing for and been on a trip to the Middle East. And as you can see, I'm actually in the plane as I record this on the flight back. But the last few weeks haven't been that great. The stock market has been down. Trump has picked up a trade war with China, picked that up and made that more intense. And that's hurt our stock prices. But generally we're doing okay. T. Rowe price is up about 7% since when we bought it. AGX Argon is up about 5.8%. Martin Transport is up also 7%. We're down 1% in Apple, not a big deal. We're down 8% in Altria Group, but remember we bought Altria Group, it went up 15 or 18%. We sold most of our stock and we just bought a little bit back. So we're still still significantly net profit in Altria. H&R Block is up 9%, so that's good. And Waddell & Reed, the last stock we bought, is down 9.4%. So all told, we're up about $1,700, and we're doing okay. Obviously, we're doing a lot better 2 weeks ago, but there's going to be some ups and downs, and we're investing for the long term. Thank you for your time, and we'll see you next week.